When did that change happen where you saw institutional capital roll into Brooklyn?
Downtown Brooklyn was rezoned in 2004. And so that was the beginning of the pivot towards institutional capital. The way the market becomes institutionalized is when your exit is through an institution.
Brooklyn has 2.6 million people, over 70 square miles. So that's like 40,000 people a mile in Brooklyn. You look at Chicago, it's basically the same size, but over 240 square miles, right? So like you think about Brooklyn just as like the perfect balance of density and population. It's got more population than Manhattan. If you're an investor and you can't find your neighborhood in Brooklyn, you're just not looking hard enough.
DJ Johnston, Stephen Palmese, two absolute studs of Brooklyn real estate. Thanks for coming on the show, guys.
Our pleasure.
Thanks for having us.
Stephen, I'll go to you first. So I'm going to get into your new firm, Integritas Capital, and I want to talk a bit about your transition over to the lending side. But first, if we were just saying off air there about you started young in the business. If we go back to 2004, you walk into Massey Knackle at the time. What was Brokerage like in 04?
So 2004, I come out of college. Bear in mind the Blackstone credit desk didn't exist, right? And like similarly, the related companies equity desk didn't exist. So those were the fields I thought I would end up into. Then I had my eyes set on Brokerage. I saw an opportunity to looking at Brooklyn. And the opportunity to build a team. But, it was August of 2004. It was a particularly hot day. I remember pulling up to the office, which then was in southern parts of Brooklyn, which were in Bay Ridge, which were, I don't think they've ever quite been cool, but, it's old-fashioned Brooklyn. And so I remember the elevator was out, and I had to walk up to the third floor. And I'm probably making up the fact that the AC was out. It's probably just like a memory I'm making up, but the AC was probably perfectly functional. And I took a pause and said, like, we were trying to institutionalize Brokerage, and looking in that office, despite it being on 86th Street, like I knew there was an opportunity, but it was very mom and pop, was the real way to put it.
This is 86th Street in Brooklyn.
Yeah, 86th Street in Brooklyn.
Right. So like this is
not
their
the Upper
first
East Side.
office was in South Brooklyn.
Right. But it was mom and pop is probably the right way to put it.
And then 6 years later, DJ, you walked into Massey Knackle, right?
Yeah.
And what was your first impression of Stephen at the time? 2010.
So, I grew up in Westchester. I grew up in Nurse Shell. Everyone around me was in finance, so I graduated school and I thought I needed to be in finance. Quickly realized that just wasn't the direction I wanted to go. I got a job at ESPN. So I spent, the first early part of my 20s, working for the Disney umbrella, which was a great experience, but it just, it wasn't giving me what I needed. I wanted to kind of progress faster. So I took a job as a sales rep selling basically digital services to law firms. So basically like data discovery and I realized pretty quickly there that, I didn't have as much sales experience as I thought. And if I didn't love what I was selling, I just wasn't any good at it. So this was all happening, in 2005 to 2008. Eventually, I lost my job in 2007 with a ton of other people in New York. And it was just an opportunity for me to do a lot of soul searching on like, what is it that I love myself, not really what my parents told me I should love or what the people around me were good at. And I kept going back to the fact that I just really loved architecture. I really loved the idea of selling something physical that you can touch. I used to always like draw the White House and stuff like that, like little stuff like that I had time to reflect on. And I happened to get, I honed in on real estate. I wasn't sure if I was going to do residential or commercial. I had a friend who was an associate at Massey Knackle in the Brooklyn office. And someone had just left, and the director at the time stepped up, and he was looking to hire some associates. And so I took the interview. I instead of meeting at the office, we met on Fulton Street in Bed-Stuy. So I get off the subway on Fulton Street in 2010, and I think he wanted to see like what was my composure like on a bustling Brooklyn street. And I have to admit, it was maybe like the second time I'd even been in Brooklyn. So and I stepped out of the subway and I just like fell in love with it. Like Fulton Street is crazy active from a retail standpoint. There's a lot of foot traffic. There's a lot of energy. I wasn't intimidated by the energy. I was like drawn to it. Then we hit the side streets, and there's all these brownstones, and we're just analyzing properties like on the spot. I'm just guessing, you know? And so I knew right there, like I didn't even go to the office yet. I just knew that real estate in that location was what I wanted to do. So, you know, like the way that I started is probably a little bit different than Stephen, because I wasn't responsible for origination. I was responsible for execution. So I was brought onto a team to help them execute their business. So I was just trying to be a sponge. I was trying to understand how this business works. And one of the greatest things about Massynackle was just being able to witness guys like Stephen execute business two seats down from me. And at the time, there was how many desks at Massynackle? I mean, how many teams? There were 9 or 10.
Fair.
And you know, Stephen was the top producer, but even the bottom producer was top tier broker. And you know, for that first year or two, I was just trying to adapt and learn from all these guys. So it was just a phenomenal place to learn.
Cut your teeth and learn.
But if you want a description, think about the landscape. Most of Brooklyn on the northern half was manufacturing. Downtown Brooklyn, Williamsburg, Greenpoint, they were manufacturing zones. Downtown Brooklyn still was very commercial, and most of the owners were immigrants or first generation of immigrants, right? So when I talk about mom and pop in nature, like you legitimately had a very underdeveloped by zoning marketplace. It was still very commercial, industrial. And then also, as you look where Bay Ridge was specifically, it was increasingly more immigrant.
So you brought up a good one, or an interesting point there about institutional capital. When did that change happen where you saw institutional capital roll into Brooklyn? If you've been wondering what types of deals we've been working on,
We made it easy for you. Just click on the link, show notes below.
we're talking real deals and real opportunities.
Whether you're an investor or owner or just curious to know what's going on behind the scenes.
Just click the link below and it'll bring you right to all of our available inventory.
Downtown Brooklyn was rezoned in 2004, and so that was the beginning of the pivot towards institutional capital. But it's really unfair to categorize it. The way the market becomes institutionalized is when your exit is through an institution, right? So you build a tall institutional building, who's your takeout? Is that multifamily an institution or otherwise? So we really just had independent sponsors who were cobbling together their equity with senior leverage, right? There was no really creative cap stack solutions available back then. So you had, you know, long-term owners, or you had, you know, new developers who were saying, hey, we're going to have a senior lender at whatever the detachment point was for the loan with common equity behind it. So it was a very sort of fundamental approach towards building. And then beyond there, Williamsburg, you know, that was rezoned, and that was, again, you had an area that was significantly, if not mostly, you know, commercially zoned. So it's like playing SimCity. Fresh start, move in for residential. And I think the real pivot towards institutional capital, I think, is actually past the financial crisis. It was probably 2014 is really when you saw that shift. So it was a good run between 2004 and 2014.
What a time to enter it. Like, I know it took talent and grit by you to persevere, but talk about like hitting the moment at the right time.
He had to grind through an incredibly tough market. You know, I came in 2010, so we were coming out of that, right? But we're coming out of the GFC. We had Bloomberg in office, right? So you had a political environment that was pro-capital. And then you had these areas that were being rezoned, and rents were increasing by 5-10%, sometimes 20% over the course of a year. So you just saw like this enormous increase in appreciation within a very tight window because you had a perfect storm of private capital and good regulation and good rezonings. The opposite of what we're seeing today.
Who was mayor in 04? Was it Bloomberg, or was it Mayor Bloomberg? I feel like, was that his time, his run? I feel like that's when everything. That's when everything.
Give me 2 seconds.
Don't ask a question unless you know the answer to it.
He was 09.
Not poli-sci majors.
I was living in Ireland, so I get a pass.
That's funny.
Yeah, but
Giuliani,
no, Giuliani was. Yeah, he would have been around 01, right after the
Yeah,
towers. So it was
after-
Giuliani. So Brooklyn obviously today is a different animal than it was even in your time, DJ. Like 15 years in the business, right? 15 years. So you've really seen. You've rode the wave pretty good yourself.
Yeah.
I mean, not bad timing, right? Do you see, Stephen mentioned Williamsburg.
Bloomberg.
Green, yeah, I was thinking. Greenpoint, obviously, downtown Brooklyn, these neighborhoods have popped, but is there going to be condos in like Crown Heights or Flatbush, or is the ingredients right there to make those types of deals?
You saying currently?
Yeah.
Do I think?
Or even coming up? Like, is that possible in these neighborhoods?
The cost of construction and the ultimate sellouts, there's a fine line, right? So the spread between buying price per buildable and your ultimate sellout needs to be $1,000 a foot. So if you're buying for $200 a foot, like you should be in a $1,200 sellout market. And so that's where condo developers get really comfortable. And that spread becomes tough once you kind of go beyond a certain point. So even areas like, you know, Bushwick and Bed-Stuy, you have a hard time breaking that $1,000, $1,100 sellout threshold. So you don't see as much condo development.
Rentals.
Right.
Right, but I think your question also was like, is there demand for condo execution?
Yeah, like as these neighborhoods get saturated and get overpriced.
You got to bear in mind I think it's more of a gross acquisition price for the purchaser versus is it a price per square foot. But yes, do I think that there's demand in broader northern Brooklyn for condo? Absolutely. You know, we had an election that was defined by New York City as too expensive. I'd be hard pressed to find any secondary market, even a tertiary market where condos aren't $1,000 a foot, right? And so execution is available for that. To DJ's point, then you have to layer in sort of externalities, lenders, capital partners, and you may have a hard time trying to convince folks that the market may be ripe for that. But, you know, home ownership, especially at a right price point, I think is applicable anywhere.
Thanks for listening to the Broker Brunch. We've now brought you a ton of episodes and we hope we're providing a lot of value. If you have any ideas of people you'd like to see on future episodes, please drop it in the comments so we can make it happen. Talk to me about your recent pivot, if we were just to change over to speak about Integritas Capital.
Yeah.
So you did a really impressive move, I would say, like someone who had an incredible business and obviously, like we're saying, like almost a 20-year run, to pick up and to move to another discipline, lending. Like, why not pick up and say, start your own firm in brokerage? Like, what was the allure to switching and going to the credit side?
You know, but we talk about, DJ mentioned before, I weathered the financial crisis. So 2008 to 2012 is when the market started to rebound. And if, you know, looking back now as an investor, like there were opportunities that were presented to me, like buy, call it brownstones in prime Brooklyn Heights or Cobble Hill that are, you know, now 5x the value. And so when they were offered to me, my reaction was I didn't have the capital. I was too nervous, right? There was always an excuse why. Ultimately, I wasn't ready. So the decision we ended up making in brokerage was create visibility as a broker. Spend time, recognize we're not going to make much money in the short term, but it'll pay off in the long run. So we spent the next really 4 years just building visibility and creating credibility. But when you ask about how I made the pivot, you know, I recognized in 2023 that, you know, the cycle changed from LIBOR to SOFR in 21 to 22, really realizing how New York City debt funds and sort of globally the private credit space had frozen in 23. I recognized that there was an opportunity that now at rounding 43 years of age, I wasn't going to miss like I missed in 2008. Arguably, I missed other opportunities in 2012 as a principal. And I knew that it was the right time to enter the private credit space. So I raised $100 million of private capital. I announced that I have this capital. We move into credit. Bear in mind, I did not have a legacy book. So I had a fresh start. Most other debt funds were still tending to their books.
That's interesting.
Right?
Yeah.
So they were still caught between A, trying to capital raise in a new environment, and B, trying to tend to their legacy books. And I was the new kid on the block. I had this capital. And I somewhat naively said to myself, hey, everyone's really nice at school today. And that was because I received a lot of inbound phone calls from debt funds saying, hey, we have this project. Would you want to work on it with us?
Yeah.
And I said, wait, that's uncommon. People want you to work with them? And so ultimately, I would receive questions like saying, hey, we have a closing in 2 weeks. We lost a part of our capital stack. Can you come into this loan and write an 8-figure check in 2 weeks? So we were able to do that successfully. And then sort of one after the other, we just kept closing loans. And then the market started to present itself to us.
So not having the baggage of the past actually worked to your advantage.
It worked out well.
I love that, flipping it into a positive. And DJ, around the same time, you were making a bit of a pivot, right? So you and I soldiered together at B6. We were saying for the guts of 5 years. You were kind of the big brother around the office, I would say.
Yeah.
You know, usually grumpy and would smack you around a bit if we got out of line. But you were a great leader.
Am I grumpy?
A great leader and a great mentor in the office. And I think
Yeah.
you really helped mold a lot of our careers in that office. Yeah. So you took your team over to Matthews. So tell me about how that's been that first couple of years. I know you're over 2 years there now.
Yeah. So like when I decided to double down on brokerage, right? Because I think I'm similar age as Stephen, and so you kind of reevaluate like what's the next 10 years of my life going to look like? Where do I want to position myself? You know, I've got this experience, so how do I leverage it? So I met with 15, 20 different firms. I actually spoke with Stephen. He gave me good advice. I appreciate that. So I kind of honed in on middle market firms. Core what I do and what I've done in the past. And I'm analytical by nature. I was trained as an associate, so I created a list of everything that was important to me. So, the brand, the white space, even the office location, basically a checklist of everything that was important to me as a broker. And as I was meeting with these different brokerages, I gave them a rating. And at the end of the day, I'd add up the rating. It was like a risk assessment. And Matthews just kept coming to the top, and what I really like about Matthews is it's familiar. It's like Massey Knackle in some ways. It was like B6 in some ways. It's middle market focused. They've got enormous exposure. They're privately owned. We've got 29 offices. We're hiring 100 people a year. And they've got great leadership. So, and they frankly gave me the white space with me and my team to come in and build out an infrastructure, a brokerage infrastructure that I believe will be incredibly effective in New York. Right, so I'm taking things from Massey Knackle, I'm taking things from Cushman Wakefield, from B6, and we're going to take over New York City. So a lot of that has to do with recruiting. I would say that, in 2012 or 2010 when I was starting, if I was a new person coming into the business and I wanted to get into brokerage, Massey Knackle was your number one choice. I would say today they don't know what their choice is, right? So we need to change that. So we're investing a lot into young brokers that want to get into this business. If they're crazy enough to get into this business, we want to talk to them. We'll train them. We'll give them a mentor. We'll give them an identity. And that's really working for us. So, at the moment, we probably have 50 people in our New York office. I would say a third of that are focused in the tri-state and on the net lease side. But, we're hiring 20, 30 people over the next 6 months to help kind of build out that exposure in New York.
So the middle market space for brokerage has a tendency to be a little bit fast, a little bit loose, a little bit what's in it for me perspective from the broker side. But the one thing that it'll never have a shortage of is the things that DJ and Matthews and then you guys at Ripco embody. It's sort of like having a altruistic outlook for the client and putting the seller first, and coming to work the way you're dressed with the outlook. That is increasingly at a shortage. And I think Matthews will have, as will Ripco have, and continue to have tremendous impact in the market, in the middle market space, just because, again, when you are tried and true, continuing to sort of embody this sort of, client first centric outlook, I don't think they'll ever have a shortage.
And for you, personally, when you think about your own shop that you're building, I mean, DJ mentioned different things that he feels they took from, maybe Massey, Cushman. What are some things that you like that some of your prior firms, and maybe some things you're trying to build on and learn from?
So I've really made a mental pivot from the word the word client to customer. I really look at the folks we work with, our borrowers, as customers. And I think it's just sort of another level of looking at and creating a personal dynamic between my responsibility to my borrower. And so these are customers, whether or not I own, a patisserie or some other restaurant, these are customers that I want to care to. I need to provide a level of hospitality to them. And it's not so much just a service. So keeping customers, content and sort of making sure that we're looking out for their interest are all the things that we learned, in 2004 or in DJ's case in 2010. And that's really a testament to Paul Massey and Bob Knackle, because they were, we used to say they were like the Yankees at the time, right? And it was their continuous like installation in us of what it means to be looking out for someone's best interest or put their interest ahead of yours is what is who we are as individuals, the three of us in this room, the folks who work at our shops, but it was the continuous reinforcement from them is really what helped shape who we are. So as I apply that moving forward, I think it's sort of a reinforcement.
What's the distinction between customer and client in your head?
I think it's the same thing effectively, but as I look towards customer, for me, it's more of a warmer.
Sounds like you're borrowing almost a hospitality type of approach to it.
It's more humanizing for the person my counterparty is.
Client evokes more of a like professional relationship, whereas a customer is more of, like you're saying, more emotional maybe. And
sort of trying to apply elements of hospitality towards this, because this is not a linear service, right? It's not a cost for goods and this transaction's over. It's like this is an ecosystem you want to create around someone. You want to keep them coming back.
Exactly, yeah.
So that's how I've tried to shift my mindset towards customer.
That's really,
it's such
really
a
good.
human business.
Yeah.
It really is.
That's the word. Humanizing.
Yeah.
Yes,
and
humanizing.
Thank you.
And I was so taken back. When I joined the industry, it was like you had to be authentic. If you weren't authentic, you were going to get weeded out. And it didn't matter. Everyone had a different kind of strategy or mindset to brokerage, but they were all true to themselves. So like the best brokers, you look at James, you look at Stephen, like they were very different in their execution, but they were authentic, and I think that's something that you really need to hold on to as a broker. And that allows you to connect with customers in just more effective ways. And it's also like we were blessed that we had this integrity just embedded in us, because it was at the core of what Massey Knuckle was this seller rep integrity, and execution and work ethic integrity. And as I'm getting to get more exposure to these young people coming into this industry, is they're so moldable, and you can mold them the wrong way or you can mold them the right way. And so
there's a responsibility with that.
It's
Isn't
really
there?
interesting, and they don't even notice. I'm like, you can't do that, and you won't do that again. And they're like, of course I won't do that again. And I believe them.
It's like having a dog, right? It's like having a puppy.
And I'm about to get a dog, I think.
Right.
I hope my daughter's not watching this, but I think she
She
subscribes.
watches my podcast.
But I think about that. I'm like, look, like you gotta, you really got to show them the way, and we were blessed that we had that.
Listen, think about when you were 22 and you came out of college. You thought you were an adult, but you're really so young, and your impressions of the world are still being presented to you. And so if not for the opportunity to work with the folks that we did, it's very easy to create bad habits. It's very easy to be lured towards short-term interest instead of long-term gain. And
especially when you're asking them to work as hard as they are.
Right.
Yeah.
Like we have a big cold call culture. It's like, look at Matthews, you probably think cold calls, and we train our new people to originate. They learn execution through their mentors, right? They learn the culture through the relationships within the firm. So when you're asking somebody to make 500 phone calls a week, 1,000 phone calls a week, sometimes they lose the human component of that, and that's what a good mentor will do, or a good leadership will do, is try to keep that integrity in place.
I think from the outside looking in at Matthews, one thing you've done really well is like you've linked the process to the overall benefit. Yeah. And I think Kyle Matthews does a really good, he's all over my social media. Like every time I open it, Kyle Matthews is there. But you can see like there's a guy who has walked the walk for so long, kind of like you, Stephen. But now he's, when he talks or when he says something, you kind of say, he's not just someone who's like reading it out of a book. He's done it himself. Yeah. You kind of, to me, Matthews seems like you do the blocking and tackling really well. Like you've got a good hustle mentality in early, stay late. And I feel like young people just buy into that so much because, like you said, they want to give their time and their energy to something. Thank you for listening to The Broker Brunch. If you enjoy the show, please hit subscribe so we can reach more people.
I felt like we lost that a little bit after COVID. I think people got on their heels. They stopped going to the office. And a lot of people weren't forcing that correction. I think Kyle, like unapologetically, was like, we're not subscribing to that. And he was a 2004. He started in 2004. You look at some of the greatest brokers in our industry. 2004 was the year that they started because they just learned so much. They learned how to grind at a very early age. And so he's taking that through to his CEO role. Like, he'll come to our office and he'll give tutorials that I am pumped. I walked out of that room and I'm just like, oh, I just.
Is it like a football coach type of mentality?
Yeah.
Yeah, where you want to run through all after speaking to him?
Yes. He takes his game very seriously. He grew up in a football family. So when it comes to like discipline, training, never quitting, these are things that are just constantly like ingrained in the culture.
A lot of transferable skills.
Yeah, and like at Massey Knuckle, we
yeah.
hired a ton of athletes too. Athletes they're competitive, but they know how to be a teammate. So you need competitive people, but you also need collaboration. And the only way that really works is through good leadership. And so, he's this interesting hybrid of all these different leaders I've met over the course. He's our age. And
Your age.
He reminds me.
Don't drag me down.
I see like Bob Knackle in him and Paul, and like I see Steven. Like I see all of these great brokers that I've known over the years, kind of, And so again, he's just one of those influencers that I take, and it becomes part of my pitch also.
By the way, side story about being conscientious of who you hire. The office had hired someone who was a salesman, right? He was the #1 medical office salesman in Ohio. Okay, and it comes to New York. Do you know the story?
No.
Comes to New York and wanted to move into brokerage, and so immediately we were receptive to him for his resume, right? Yeah. And so, but some things that don't translate and that we didn't recognize is that he was petrified of the phone. This was like a 30-something-year-old man literally crying because he had a phobia of the phone.
Right.
So what doesn't translate is he made all of his business in medical office in person.
Yeah.
So he was a door-to-door salesman, and so he was good at this, and he didn't know how to get that same door-to-door connection with real estate owners. And that's why it required phone calls, right? And so he was petrified. Unfortunately, it didn't work out for him. But to your point, you've got to find people who are going to find the pathway to make
There's a balance, right?
Yeah.
And you can't exclude. You have to be likable. You have to approach presentations with finesse and with preparation. And I fall victim to this, where it's like I'm not making enough phone calls, and it clearly reflects in your OV origination and then ultimately your income. So it's like whether it's 30% of what you do or 70% of what you do, like it is critical that it is a part of your brokerage approach. It's just picking up the phone and hitting some cold calls. So it's something that I've gotten better at just in the last 2 years of being at Matthews. Like where before it was like, oh, how can I get creative with my mailers? How can I get creative with my case studies? Okay, well, I've done that. Now what? It's like, you got to get it out there and you have to have these conversations. But, Bob will say it's like 50 connections a week. That's more effective than 500 cold calls, right? But like, how do you get to that 50 connections a week?
And you have to be authentic to yourself. I feel like you hit on that as well. Like what Stephen was saying, if meetings work for that guy, then you have to find a way to get in the room with folks.
Correct.
It's not that you can't do brokerage. It's just that you need to find your angle. Some folks are killers on the phone. Some folks just crush meetings. But whatever it is in this business, one thing that I always love about it is there's a role for everybody.
Yeah.
Whether you're analytical, whether you like pitching, whether, there's something in it.
I was in a meeting just the other day I was at a brokerage firm, but a credit broker, right? So a debt broker. And so some of the folks wanted to talk to me, and he was like, hey, he has his call list, and he was looking for recommendations for me, and here's all my developers, and he was having a hard time connecting with them. So somewhat similarly, I said, you've just provided for me your own list of developers and all their projects. I said, where do they go to work every day? On site, right? You know where their sites are.
Right.
I said, you need to get out of the office and you need to get into the street and show up at their office. Mm-hmm. And for a debt broker who was, reasonably mature, I was like, that wasn't connecting with him.
Yeah.
And I was like, turn this computer off and go out there and visit every project.
Sometimes that's required. I know for myself, even like there's a comfort to going in, drinking your coffee at your desk, pulling up your screens, and you have your whole control panel right in front of you. But then sometimes you go out into the field, or you even just going for lunches, or you go out for happy hours, and you just start connecting with the people that you're trying to do business with. It's so much more enjoyable. I get so much energy from it, and every time I do it, I'm like, I need to do this more. I need to do it more.
It's why I'm in this business.
Right.
I'll schedule a day where I'm just out in the neighborhood all day long, and it just rejuvenates me. You know, like once every 2 weeks, I just need to be out there for the entire day, just working from my car. Right. And it's like Paul always said, it's like you never walked away without finding a lead. You see a for sale by owner, you connect with a super, like it
Supers are always around.
Always ends to something. You know, I was in like South Bushwick at this like dodgy deli getting a coffee. And I turn around and I like bump into a client who owned a development site, a big development site. He probably is in Bushwick once a year. And he's like, DJ. I'm like, hey, what's going on, Adam? I'm like, how you doing? And we talked and whatever. And then a year later, he calls me. He's like, I want you to sell my development site. He's like, I could hire X, Y, I can all these great brokers, but like I would have never run into any of them at a bodega in South Bushwick. Like you were in your hood. Like that's the type of person I want to hire. So
Good story.
It's a good story. I think about it, and I tell the young guys, I'm like, like we had guys at Massey Knackle that like got physically hurt canvassing their markets, you know, because they had to do it. They had to canvass 500 properties, 1,000 properties.
Yeah.
And like they're like, you know, like their livers were hurting like after a month of like just walking and walking and walking. But like that's the point. You got to be in your hood.
And DJ, you got to know your market. Like Stephen hit on it. Like these guys have been there long before any of us were born, right? Their parents owned the buildings. Their mom and pop owners. They don't respect the suit or the phone call. They respect like seeing a guy in the flesh that understands their market. And I feel like if you want to be a Manhattan broker who's trying to sell office buildings, you have to know how to get in the door of, you know, your clients' offices. But when you're trying to sell mom and pop buildings or people who own businesses, like you got to show up.
Yeah, they don't.
It's the same in the Bronx where we do a lot of deals. You know, you have to go there, press the flesh, whatever you want to call it. They need to see it.
I always remind people, Brooklyn has 2.6 million people, over 70 square miles. So that's like 40,000 people a mile in Brooklyn. You look at Chicago, it's basically the same size, but over 240 square miles, right? So like you think about Brooklyn just as like the perfect balance of density and population. It's got more population than Manhattan, but Manhattan's 22 square miles or something like that. So it's really like if you're an investor, and you can't find your neighborhood in Brooklyn, like you're just not looking hard enough, because every pocket is different. It's a different inning in the cycle, or it's got different more rent per, upside than others, or it's got better transportation, or the building stock is different. But it really is a borough of 1,000 different neighborhoods with 1,000 different trends, and the owners in those markets care about what's happening in that specific area. They don't care that Manhattan saw $3 billion worth of dollar volume. They want to know why that mixed-use building just traded for $375 a foot,
and who bought
and the rent-stabilized building next door traded for $75 a foot. So again, it's like New York really forces you to get hyper like location focused, because that's what your clients care about.
Let's talk about development, because I know it's a special focus for both of you, and you're both super experienced in it. So Stephen, I'll go to you. When you're looking at a development site, and you've seen so many of them at this point, what are some, and I guess with your lending hat on, what are some key indicators that you're looking for that this site's going to be successful, or that this has the right ingredients?
It's refreshing to talk about New York land, because as you look in the rest of the country, there are parts of the country, even very prominent markets, whereby land sometimes doesn't have value, right? And so New York land always has value. And in other parts of the country, you don't want to be stuck left holding the land, even if it provides, on paper, a great opportunity, because you don't want to service the land. And then you're really just captive to when the capital markets and the institutional markets unthaw and decide that they want to repatriate capital, which would then take your land and have value. So as you look at New York City real estate, it always has value, right? And all the elements DJ mentioned, finite number of people, or a lot of people in a finite number area. But I think as I look at it as on the credit lending side, it's who the borrower is, right? We talk in terms of price per buildable square foot, but the other side of that coin is what is the development budget, and who is the party delivering that budget?
Their track record, like what
correct,
they've done.
their ability, right? And then who is the GC, and behind the GC, what are those subs, right? And how am I confident that this is going to come together as it's measured on paper? And so for me, it's the borrower.
Going back to the human aspect of the whole business, and it really is the person asking for the money is who you're focused on more than the site. Is that fair to say?
But as you look through that too, if you just walk around New York, right, there aren't many buildings you could consciously say that are stalled developments. So development will or tends to get built, but what you don't realize until sort of the defects afterwards, if there are many, right? There's 7 years for developers, right? So but especially in Williamsburg, we would look at this, buildings would get built, and then you'd start all the stories that come out about how there wouldn't be much efficacy to these assets. So that goes back to the human element, right? So this person we sold this land to, they were credible, they transacted, they built it, but they built it with merit, right? And then was this built to withstand time, or was this built just to make a profit in the short term? And then that's a good thing about New York. Those borrowers start to get weeded out. Those buyers get weeded out.
The market's efficient like that.
The market's efficient.
Yeah.
Yeah, the land value is the last thing that gets calculated, right? So you're looking at debt, you're looking at hard costs, you're looking at soft costs, you're looking at future rental values, you're looking at the experience of the sponsor, right, to get to a land value.
Yeah.
Right. So I love development. Development's one of the best asset types in New York right now. So if I can get my hands on a development site, 9 times out of 10 it's trading, where the average success rate of a multifamily building across all brokerages is about 40%. So development sites, we spend a lot of time on. What we're noticing is that there's a trend. It used to be that developers would become builders. They would build the infrastructure to become a builder. So they would basically vertically integrate so that they could bring down their construction costs. We're seeing a lot of builders stepping in the developers' position, saying like, okay, we've been building for you guys for so long. We control the hard costs. Why aren't we raising the money to go and do this? So there's been this kind of pivot, and I think Brooklyn developers are incredibly efficient at this, where they know how to build at a hard cost that makes them incredibly competitive from a land value standpoint. So for deals over 100,000 buildable, like that becomes more institutional. For deals in the 20 to 100,000 buildable range, there's a deep roster of Brooklyn developers that have a lot of building experience that can keep their hard costs at $280 a foot to justify paying $250 a buildable for a piece of land in Bushwick.
And a similar question that I asked Steve. So for you, when you're looking at it, you're looking at a piece of land. How do you know that buyers will bite, that there will be demand? Like, what are some of the
regularity of the lot is important. The density,
footprint,
the nuances of the zoning. So certain zonings in New York have certain bonuses that are beneficial to some sites, or not so beneficial to others. You're talking to developers all the time, so you're getting a sense on what neighborhoods they believe in, and so. I can triangulate pretty efficiently within 10 buildable what a piece of land would trade for, just based on our experience selling development sites. But it's we're a lot of times it comes down to what type of due diligence can be provided. Do you have a zoning? Do you have a zoning study? Do you have environmental? A lot of times it's a negotiation of terms, particularly with City of Yes. You're dealing with an MIH structure now, which is different, so the timeline to close is longer. So price discovery is almost secondary to certainty of execution.
On that point, price discovery, City of Yes, so it was an initiative brought out by Mayor Adams last year, and long story short, there's more square footage applied to most sites in the city. How do you handle the question from owners of how much has my site gone up in value?
I mean, I can show them a pretty generic underwriting, that would suggest that their values have gone up 7%.
7.
Yeah.
Because I'm always having this dance with 20, them that they can build more, but it's not really that valuable.
It extends their development timeline, which is money.
Right.
Their affordability is higher.
Yeah.
Right.
Their affordable housing units are different sourcing structure. So
it's a yes but answer. Yes but.
Yeah. Yeah, which is always fun.
It
with
works
an
better
owner.
with more scale, so the smaller sites don't benefit as much.
Uh-huh.
But what it did do is it allowed sites that would have been priced solely for condo, the rental developers can compete with the condo guys because they're getting a 20% bonus, and so it's evening that field a little bit.
Evens the field. And Steve,
Yeah.
are you seeing then on your side, like, are these City of Yes 485X, which was the property tax abatement that replaced 421A, are you seeing these get built? Are you financing any of these in New York City?
We financed a product in Park Slope that was a mid-$60s million construction loan. So that was the first loan that we closed in 18 months. That was for ground-up construction in Park Slope. And so we were, that, for the reasons DJ described, like perfectly keen on the opportunity. We don't see there being a shortage of demand for rentals, especially around a transit-oriented development. In this case, it was downtown Brooklyn or Park Slope. But that's clearly where the market's moving to.
We're seeing an enormous amount of demand because you have a lot of these rezonings that are, since 2004, industrial to residential, MIH. You saw it in Inwood, you see it on Atlantic Avenue, Gowan is the biggest example. So these are industrial owners that all of a sudden, Jamaica rezoning, right? You have all these industrial owners that have run a business there for 50 years, and now their value of their land just quadrupled, and they want to sell. They don't know how to be landlords. So the 1031 is an option, but they don't really love that option. So they're turning to ground leases. And it's something that's always been on our radar, but for whatever reason, the last 12 months, we've done 4 ground leases. And I think developers, particularly the builders that have become developers, are very like, okay, I don't have to raise as much equity. I know how to control the construction budget. I'll invest the equity to get my foundation in place, and then I'll go raise a construction loan under the ground lease. Maybe they'll negotiate in a buyout in 5 years or 6 years. But the ground lease structure, I think, is something that we've become very savvy with, and I've had the pleasure of sitting in a 3-day negotiation with 2 attorneys negotiating a 99-year contract between 2 parties, and it's magic. It's really cool to see those type of agreements get played out. But I think that's going to be more and more common. And developers are paying more and more for these ground leases, where it's really a better option for a lot of these guys than doing a 1031. Have you seen any of those? Like, have you?
Yeah, sure. The funny part about time is that you can't control it, right? You're just in time. And so we've seen a developer who started a rental project before 2022. So he's contemplated the project in 21, capitalized it, conceptualized it, and so suddenly on a ground lease. And so that dynamic has changed pretty dramatically. And so, he now has a construction takeout, but he also built this in, an area whereby it's not a primary market, it's a secondary market. He has a number of 130 AMI units. 130 AMI is someone who's making $125,000. If you're in a secondary market, you may not be walking around thinking that I qualify for this concept of MIH. Right. So, he has a ground lease, he has a construction loan he needs to take out. And so the point I'm getting at is, doesn't have full occupancy, despite the fact that it was a really well-built asset, because he doesn't have all the lease up. That takes time. Ends up getting a refinance, but at every pass of new form of non-permanent financing, his equity is shrinking. Right. And, more and more developers are saying, wait a minute, you negotiated a ground lease at a very different point in time. Those ground leases aren't negotiated in the same way as they are today. Right. Or like the disparity between a freehold interest on a sale for a multifamily versus a leasehold sale or widening, right? There used to be, 25 basis points arguably between a cap rate on a sale for a multifamily on a ground lease versus a fee interest. And even a point of in parity. Now that's easily 100 basis points wider.
Which it should be. Right. Because you got to repay yourself over 100 years. Right. So it's a percent of a point a year. So like the cap rate on a ground lease, say it's the market's 6, it should be 7 on a ground lease. You got to recoup your principal.
You got to get paid, right?
So as a lender, it's riskier because you don't control, you're not at the bottom of the capital stack. The landowner is. So, but if you're the landowner, all of this excitement's happening above you, and you're in a pretty safe position. But obviously, like, everyone wants to see the project get done. That's why you got to pick a developer that has experience and that has the equity to not over leverage. But like you said, you can't control time, and like these projects aren't guaranteed to deliver.
We're back. Another season of the Broker Brunch podcast. Summertime in New York. We've got a lot of exciting conversations coming up. We hope you enjoy listening.
And then outside of development, if we think of just the broader market, Stephen, for you, like what kind of deals is capital consistently chasing? Like what do investors like right now outside of development?
You're saying where their capital flows?
Yeah. We all hear about like office class A has really, like, obviously Sean Bright, and then B and C has really struggled. Hospitality seems to be doing really well, right? I know you speak a little bit about iOS sites too. I mean,
Sure.
is that really where you see the hockey puck moving?
There is, for every category of real estate, there is a business thesis. You know, for the multifamily investors, they were putting out capital. They were buying 4 caps. They wanted to raise rates. They wanted to raise the NOI, sell it a 5 cap, right? And then, they wanted to buy 4 caps, raise it to a 5, and sell it again at a 4, right? It was a 4-5-4 buyer. That market,
4-5,
right? So that market's really just adjusted. They're trying to buy 5 caps, raise to a 6, and sell it a 5, right? And so, you know, you would think that despite the change in the macro market, that people would look for different business plans, but they're back to their same tricks. They're just adjusted for what the market is. So
6-7 now.
right.
6-7,
Right.
7-6.
Perfect segue to 6-7, which I want to hit on.
So we're seeing capital flows in all sectors. I think it just takes your own independent viewpoint to decide where you want to put your capital or not.
Let me ask you this, right? So we have a new mayor-elect, right? So Zoran Mamdani, he's coming in. There's a lot of anxiety out there about some of his policies from a lot of our customers, our real estate owners. Do you see, I'll ask you, DJ, what you think, if it'll have any effect, but Stephen, do you see New York's like difficulty being maybe Florida's opportunity or other markets around the country?
You know, Florida's kind of overbought. You know, they're again, Florida's doing a really good job. Whomever runs like Florida's PR department's doing a really good job at trying to create the perception that people are moving in droves to there. And don't get me wrong, people are moving, but very hard to buy and very hard to make a project work in Florida. And
Why, oversaturated with buyers?
you know, a lot of the zoning is high density zoning. So it's very hard to have a high density, so a tower site work in today's environment. So we talk about land. You may not want to own land in certain parts of Florida because there's no debt or equity available for a tower, right? Because rents are only so much. In New York, we're spoiled. Rents are $120 a foot or more when you build a project here. So you could warrant a $600 a foot hard cost or more. Rents are strong in Florida, but they're half of New York market rents, right? So the dynamic isn't quite there to warrant building towers. But even so, even building horizontal projects, right? Even, sort of mid-rise or low-rise projects are very expensive too, because there's a lot of improvements you have to make that are below the surface. We're looking at a non-performing loan on a project where a borrower spent $50 million just on improvements, sewers, roadways, electric, and then you're looking at it, you're like, wait a minute, it looks like a piece of land, but the borrower spent $50 million getting it ready for development, right?
Yeah.
And so
That's what you don't hear, I guess, in the headlines.
What makes New York great is the as of right kind of
and the infrastructure
regularity
that's
to
already
it.
exists,
It's
right?
political risk.
You're
It's
tapping
not,
in.
you're right, New York,
Political risk, right?
New York land is expensive because it is as of right.
right. It's a gift. Yeah.
You could look online and see what the zoning is, and where you and I in some markets could be competing for the same project, and ultimately we could have 2 different results for what we get on that piece of land.
Yeah. Even when we sell development sites in Westchester, completely different process than selling it. We have development teams in Atlanta, and they are incredibly more sophisticated than we are about getting permits and the construction plan because they have to be. Where we kind of have that luxury of this is your as of right, this is what we know you can build, this is the timeline that you're going to do it. And so there's a big advantage for development.
But answer your question on the mayor, there are definitely groups across the capital stack that have their own house views, and some are red light, hey, we're not going to be investing in New York consistent with our business plan in any way or form. We want to see what happens. And there are other groups that have a different house view that, It's still New York. It's still going to be short on housing inventory. We still want to acquire. There are groups who are saying, I don't want to be buying rent stabilized products right now. And I think that's probably a broadly shared view.
Sure.
Rent stabilization may have some more impacts to come. Certainly as a category, rent stabilization assets or rent stabilized assets have a history of declining NOI, right? Rents don't increase as high as expenses do. That may compound more dramatically, which may make that asset class furthermore out of vogue. But New York City, I still think, depending on what it is, certainly let's look at the office sector and where people are moving back into, I think there are still a fair amount of opportunities.
The equity guys behind my type of deals are probably different than the ones behind Stephen's. So when he won the primary, I think that's when things got baked in. So
Right,
the New
like
York,
June, July.
yeah,
That's when I felt like I had
the New
biggest
Yorkers
sense of
started
turbulence.
coming to terms with the fact that could be a reality, right?
Yeah.
It was interesting. We have, let's say 40 listings on the market that we're active on, and most of them go to New York operators. There were 2 that we had out-of-state buyers that had accepted offers. Those 2 backed out. So small checks, these are $1-2 million private owners, but they got spooked by the mayor election. The New Yorkers did not, or at least they continue to submit their LOIs, and they're moving forward, cautiously but status quo. So that was kind of an interesting trend that we saw. And I mean, you can spend 2 hours talking about the mayor position or the political environment of New York, but for me, it's tough because he has no precedent. We have no idea what he's capable of because he is only 30 years old.
Right.
So what to expect is what's scary, right? It is a bit of time will tell, and so we just have to be ready. We be as prepared as we can. I think that there's a lot of sound bites that he used as far as freezing rent, and those are to get votes. I think in execution, it's a lot harder. I hope he focuses a lot on just controlling education costs and obviously providing affordable housing. I think we all agree that needs to happen.
I'd like to think he keeps New York safe.
Safe. That's what I was just going to say. To me, the most important thing is that our neighborhoods remain safe, and that's a policing strategy. And we saw it happen after COVID, right? There's certain neighborhoods that were really coming into their own. COVID happened, police force wasn't present, and you felt it. And right now in Brooklyn, the neighborhoods feel good. Like you walk down these neighborhoods, you're like, I just love it out here. And I know how quickly that can turn if it's not policed properly. And so that's my biggest thing is as long as we can keep these neighborhoods safe, I think we're going to figure out the rest.
As we enter into a period of maybe a lower interest rate environment, I was just thinking that when I entered the business, interest rates were fairly flat. They stayed flat for a long time. And then a few years into it, they soared to where they are today. But I've never sold into a market where interest rates have really been dropping drastically. I've sold into markets where it dipped a little bit. But if it does drop, I'm curious, what happens to the values of these buildings when, so the interest rates are lower, but if there's a flood of sellers on the market, does that wipe out any gains for an owner?
Yeah. So listen, it's not a direct correlation, but obviously we're in an interest rate sensitive market almost directly, and that's a reflection of the 2019 rent laws change that just took out most of the upside of this market. So outside of development and smaller value add, it's really hard to find value add opportunities where you can pro forma into an IRR or promote, right? So you're so focused on the cash on cash, and it's like, that's why cap rates are where they are. It's like if you're borrowing at 6 and you're buying a 7 cap and banks aren't giving you interest only, they're giving amortization, like to generate a 6% return to your equity partners, like you have to buy at a 7 cap. So, if that average interest rate goes to 5.5 or 5, sure, cap rates are going to go from 7 to 6.5. I don't think interest rates going down 100 basis points is going to drop cap rates 100 basis points. At Massey, we would track that spread, that risk premium. Traditionally, it was like 150 basis points between where your local regional banks' interest rates were and where your cap rates were. Right now, it's like 75 to 100 basis points. So there's room there where I think investors are going to expect, better return on equity, which again, like we see a 100 basis point reduction in interest rates, maybe we get a 50 basis point reduction in cap rates, but they are 100% correlated.
Stephen, as we wrap then 25 and look into 26, what are some big bets you're willing to make about 2026?
You want to expand on that question? Because, I mean, you're in that field better than, more so than I am. But
Somewhat similarly, you talk about the rent loss change in 19. It wasn't for us, but someone came to us with a rent stabilized loan. And so they paid a 4 cap in 2017.
Mm-hmm.
And so when they bought that at a 4 cap, they clearly anticipated a clear pathway towards increasing their top line.
Mm-hmm.
And so that asset today is worth whatever the cap rate is, right?
7.5, yeah.
And
a clean one.
so they have, 8 figures of trapped equity in this project that I don't know that, or I should say more confidently, even with an interest rate environment change, 25 bips, 50 bips, 100 bips, 150 bips, I don't know how
Doesn't rescue them.
I don't know how they ever recover from that. And so, there's a little more complicated. They had a CMBS loan when they bought it, and now they're in default. So now they're putting new money in to get out of their CMBS loan. But I think the concept of being able to catch up to their lost equity, I don't know if that ever
I
recovers.
think that's a really good phrase, trapped equity.
Yeah,
That's
and
what it is,
and
right?
it could take 10 years for that to, like, you look at the amount of valuations that we do. We do 50 valuations a month, which is a lot of informational. And I would say 25% of them are for servicers, right? So it is amazing to see kind of behind the curtain how many New York City multifamily buildings are likely going to get taken back. And we track these comps, so like just this week, I was underwriting a building. I pulled every building in Bed-Stuy that traded above $2.5 million. I'm just curious, like 6 to 10 units. And, you pull up the trades, 15 pop up, which isn't a lot to begin with. But then I'm looking at them, 5 of them were credit bids. So these are banks taking back buildings through a bankruptcy or foreclosure. So that gets tracked as a transaction, but it's really not. It's really the lender taking this back. So that's a small focus group, but it's it was 20% of the transactions were actually lenders taking back properties through an auction. So that's a ratio that we got to keep tracking, and it's something that if that continues to happen, that keeps inventory high with very motivated sellers, which could have an adverse effect on ultimate values because you have all this inventory out there from the lenders that are driving up inventory.
You need to cycle through that as well, right?
And that can take a long time.
Steve, back to you on 26 bets. Got out for me.
Oh, yeah.
Or to kick us out of the studio.
2020. I think 26 is going to be more of the same. I don't know that we'll see large changes in the way business is conducted over the next year. I think it's still, for New York, again, we look at the large occupiers, they've retrenched in New York. That goes back to the mayor, whether or not it's Citadel, JP Morgan, all these firms have retrenched here. I think you'll still continue to see a rebound in the office sector, especially as the 5-day work ethic starts to continue to grow. Our business is going to continue to focus on, larger scale construction projects. Fortunately, New York is not our only market as much as our home market. So I'm not expecting to see any dramatic changes in the way business is done. There's still this sort of overriding sentiment that the macro markets need to change. So by and large, I think a lot of projects are probably sidelined, waiting for this sort of moment, which really isn't a moment. It's more of a structural change, whereby they'll be able to sort of be more active in the marketplace.
DJ, I'll fire the last word to you, my friend. So 2025, they said stay alive till 25.
We
did.
Now all the kids are saying
We're
6,
alive.
7.
Yeah.
6, 7. Is it 26 or is it 27? Are we going to see lift
I
off?
think there'll be like a little decompression. I think if we can see just a minor move in rates, I think that'll take a lot of pressure off. I look at a lot of the listings that we have, we're $100,000 off. Like we are very close.
You're tight.
Where it's really coming down to, in some cases, like 25, 50 grand. And it's like, come on.
I know we've got to go, but it's so wild. It always fascinated me in the brokerage how such a finite amount of money prevented a deal from closing.
Yes.
Like
That's
ego.
the story
I
of
think,
my
is a lot
life.
of the time,
50
right?
grand on, even if it's $1 million deal, like, you know what I'm
Right.
talking about? Like, let alone
If your hold is going to be 10 years or whatever the average is, I mean, why is this even a conversation?
that's the human element. You're like,
Ego.
just see,
It
Yeah.
has to be
just
ego.
see the bigger picture and move on, right? Or 100 grand, right? I mean,
James Nelson wrote a letter to Warren Buffett in like 2010 or something like that, saying like buy every building you can in Brooklyn. And
Wait, is that true?
yes, it
That's
was, and it's a
amazing.
good letter. And he should have, because like and I think we're in one of those moments where like if you have the equity that will get behind it, like the right product in the right location, it's like you want to buy as much as you can because there's this human element that's not budging that extra 1%. Just don't be the guy who missed out, was the third bidder on every deal that happened. I saw that happen in 2011 and 2012 where the same guy showed up to every listing and he was always the third bidder and he didn't buy anything. And I'm like, man, and that's why you're doing what you're doing now. It's like, don't miss it. Like,
Don't miss it.
don't miss it. But I do just, I'm not going to expect anything grand. We've kind of lived in this life for the last 2 years where like pricing has been relatively stagnant, and I'm not going to expect crazy adjustments. I think there'll be an uptick in development because of these rezonings in Jamaica and Atlantic Avenue. So like, I think the development market will really continue to blossom. So I think it's a good year. It's a good couple of years to be an affordable developer. But I think the special servicers are going to really start unloading product this year. So that's something, if you're a buyer, keep an eye out for that stuff because they don't undersell. They want to sell at market. Like don't get me wrong, but the
regulator is putting pressure on the banks.
Yeah.
To have a reconciliation of the books that'll be critical.
And so there'll be a pricing reset to a degree, and if we can combine that with a little bit of interest rate help, I don't know, could be a good year transactionally.
DJ, Stephen, I love hearing both of your perspectives. Thanks so much for coming on.
Thanks for having us.
Appreciate you guys.
Appreciate it.
Cheers.